Good morning, everybody. Hey, it is Thursday. You can tell I am not at the office this morning. We have closed for the tropical storm, and it has been one of those evenings. For some reason, woke up about 1:30 and heard all the wind, and just had a hard time going back to sleep as I heard all kinds of things happening out there. So a little rough morning to start out with, but we've got some things to talk about when it comes to what's happening in the markets and across the world. And we'll talk about that and more when Dave joins us here in just a few seconds. Before we do that, though, I just want to remind you of a couple things. One is that tomorrow, Veterans Day, November 11th, is our annual shred day. Come join us, get your stuff shredded. We'll be there from 10 to 2. Have the shred truck there, and we will be serving hot dogs, chips, drinks. We'll also have the NV donut truck there, so you can get you some donuts. And we look forward to seeing you there tomorrow, 10 to 2, November 11th, for our annual shred day. Hey, with that, also want to remind you that in the world we live, there's a lot of things that you and I cannot control, but we can control your certain things within your portfolio. One is how much risk you have. But you have to know how much risk is in your portfolio in order to decide if it's too much, just right, or not enough. Give us a call at 863-382-0037 to schedule your core retirement analysis, where we'll help you analyze where you are, talk about designing the portfolio you need and the retirement you desire. With that, we've got Dave coming up next.
0.7 Highlands Light FM, Narrow Sparkly's there. We're at 8:39. Played a short record primarily because I knew it was going to be a pretty doggone busy day as far as government data dump, and we look in to see what's happening to your money this morning. And what happened this morning about 5 minutes ago is we took a U-turn. Let's find out where the U-turn came from. It's a good U-turn, by the way, because Phillip Statler is on the phone from Statler Financial Services. Phillip, good morning. Boy, when you get just a little bit of good inflation news, the market's perfectly willing to go apey over it, isn't it?
And it did definitely go apey this morning, Dave. You know, I got to say that I'm looking at the numbers and thinking this is crazy, because yesterday was a pretty crappy day, but we made up. I mean, if it continues, let's just make sure we got that under control. If it continues at the rate it's going right now, we will definitely make up all the losses that we occurred yesterday.
And that would be a pretty good-sized recovery, because we were down 647 points on the Dow yesterday, down 80 on the S&P, and down 263 on the NASDAQ off of the uncertainty from the election. And the uncertainty ain't over yet, but what's exciting the market right now is we got the CPI number in, consumer inflation, out of the government. And my reaction on the phone before we went on the air was, boy, I'll bet you Joe Biden wished he'd had this number about 5 days ago. Consumer price index, month over month, less than expected. Core, the thing that we watch the most carefully because it eliminates the volatile stuff, only up 0.3%. And the overall CPI inflation rate as of this past month, down to 7.7%. Not only that's a full half a percentage point less than the prior month, but it's even less than the government expected, which is kind of a pleasant surprise, because it doesn't feel that way to me when I go grocery shopping.
Well, that's true, but let's remember, grocery shopping's, you know, especially when you're talking about the core, is not included in the core number. So, but you're right, better than expected. And I'm going to tell you, the futures loved those numbers, and I mean, the initial bounce was 2% or better, pretty much across all indexes. So they really are taking advantage of that this morning. The question is, you know, is this just a reactionary bounce, or is this something that can continue on? The headlines I've seen, it says, be cautious of it being just a relief rally.
I was going to say the cynic in me says, okay, fine, that's better than we expected, but I don't really want to stick with 7.5% inflation for as long as the eye can see. And we've got a Federal Reserve Market Committee that's been saying we're just going to keep beating this thing with sticks until we get it down to 2%. So I've got to believe we really don't have any functional change in what we're looking at. We're just we're starting to see some effect of those first couple of rate increases now.
I think that's exactly what it is, Dave. We're finally seeing, and it's been, let's face it, since the real big one, the first one was May. So you figure May, well, 6 months, that's October. So, or October, November. So we're starting to see that first main rate hike take some effect. And we still got 3 more to factor in over the next several months. So just think what that's going to do to us.
Yeah, that 6 months number is the thing that I've been bandying out. That, I mean, you bump the interest rates up, and what you're doing is you're looking at renewing and rolling over bonds and adjusting rates on variable rate business loans and everything. All of that junk going into the economy takes about 6 months to wash in. So, as you say, we're looking at the May big bump rate now starting to have an effect, and obviously it's having a good effect. We bumped the year-over-year rate down to down by a full 0.5%. So let's get another 0.5% off of the June increase. We'll start seeing that next month. Well, wait a minute here. We're going to start feeling this month's increase from November, starting at about May or June of next year, and we don't know whether it's going to be too much or not.
That's absolutely right. I'm looking at the effect it's having on the 2-year Treasury right now. It's down. I mean, if you remember, we hit a high point on the 2-year Treasury of 4.75%. It's dropped this morning down to 4.4%. So it's affecting some interest rates, which is, I guess, kind of good news, at least for our government.
What's it doing to the 30-year? You've got the more current stuff. The long term.
The 30-year is still at 4.2% right now.
Okay, so it hasn't bumped them up substantially yet.
It's come down. It's come down from that high.
Okay, we wanted higher interest rates. What gives?
I don't know, man. I guess yeah, they're liking what they're seeing, I guess, from the inflation standpoint, and they're willing to take a little bit less right now.
Exactly. The other government data dump figure that we got out that probably doesn't have much of an impact, but it does at the very least kind of reassure us the employment market hasn't completely gotten flushed yet. Was first-time unemployment claims came in just 5,000 over what was expected. We expected 220,000 first-time claims, got 225. On paper and on a macro standpoint, the employment picture is okay, but boy, oh boy, did it hit the newspapers and the news sites like a brick last night when Mark Zuckerberg at Meta and Facebook said, guys, I'm sorry, I got to fire 11,000 people. And there's a little crack in an armor going on there, isn't there?
There really is, Dave. And so I pulled up an article of all the tech companies that have announced layoffs or have already laid folks off. Obviously, Meta, Facebook is the top of the list at 11,000. I mean, that's probably the biggest one I've seen.
Probably because they've got more employees. So just as a percentage basis, Musk is throwing 50% of Twitter's employees out, but they've only got about a fifth as many employees.
Exactly, and that's what I was going to next. Is Twitter's about 3,700 jobs, Lyft cut 700 jobs, Stripe cut 1,100 jobs, Coinbase has cut 1,100 jobs, Shopify has about 1,000 jobs, Netflix 450 job cuts, Microsoft a little less than 1,000, Snap a little more than 1,000, Robinhood laid off 31% of their staff. Chime, I'm not sure who Chime is, but they've cut 160 jobs. Tesla cut 10% of their salaried employees. I mean, you start adding that up, and that's a pretty good round of layoffs that are coming here pretty soon.
Now, a lot of them are out in California. There's 60 and 90 days before they're actually going to hit the unemployment rolls because of California's rather kind, let's say, just for the sake of keeping it politically neutral. They're very kind with their required severance pay laws. But even so, that's the kind of a number that's enough to move the needle nationally. Just Facebook alone is enough to move the needle nationally.
Yeah, it really is. And then that's all tech companies, right? So there's also an article about Wall Street laying off. Well, obviously, the numbers aren't as big, but it does indicate that we're laying folks off. I mean, you got Citigroup that's getting rid of 50 folks out of their trading department. London-based Barclays is cutting 200 positions. Probably the big deal is going to be, where was it? I just saw one of those companies is cutting like almost 1,000 people out of their office, and they want to cut another 2,500 by year after next.
And this sounds terrible to say it, but that's exactly what the Federal Reserve wants to see. Put a few more people on the job market, eat up those jobs that are open so that the number of people looking for work and the number of jobs available come a little bit closer to matching. If you're one of the individuals affected by it, that sounds terribly cruel. But on a macro basis, it is kind of what the Fed has in mind to begin with.
It is, Dave, because the Fed has been pretty out there telling folks that, hey, we want inflation down. And part of inflation being down is bringing wage inflation down. And the only way to do that is to have a higher unemployment rate. And so I think I've seen it where they want the unemployment rate to be somewhere around 4.5%. And, the definition of full employment is really 5% unemployment. And so we've been way below that for a long time now.
Yeah, I think a few years ago we kind of informally, for lack of a better term, redefined full employment as 4 to 4.5. But basically, the Fed wants to get back to that traditional definition instead of having this 3.5% stuff. That means basically we've got 5 times as many jobs as we have people ready to fill them, which that's not good either. When you overheat, take the wage inflation to the side, because that also means we make more money. But if we don't have people to fill the jobs that are getting done, that need getting done, we simply, we can't move forward. That's a stifling effect in its own right.
Yeah, it is. And so to me, what's going to be interesting is when the next job openings report comes out, and that's probably not going to come out until December now. But that one's going to be interesting to see how the things we're seeing now are going to affect the number of job openings that are available. And it would be nice to see that number drop significantly down to like 7,500 this next reporting cycle, because it's still been between 10 11 million. So it'd be nice if it dropped to 7.5 million.
Yeah, which mean we filled some of those 10 million jobs. It'd be kind of nice.
Or that they've taken them off the table.
That too, one way or the other, having the number of jobs available come closer to matching the number of people looking for them is just the picture of a properly functioning economy, assuming the jobs match the people's capabilities.
Yep, exactly.
Absolutely. Another just macro overlook, we're now about 90% of the way through the Standard & Poor's 500's earnings season, and I started finding some of the statistics out. Now, granted, the expectations have not been as high as they have been in prior years, but so far, according to my tip sheet here, 69% of the Standard & Poor's 500 companies that have reported so far during earnings season have beaten analysts' estimates, and that's kind of provided a cushion while we've been whacking people with higher interest rates. The fact of the matter is the companies that we're trading stock on are generally doing what they say they were going to do, and that's the primary mission of a corporate CEO, right?
Exactly. I would like to see the number, because let's face it, it's what you're doing for me now. It'd be interesting to see how many people actually were able to beat their same quarter last year numbers, because I bet that would be drastically different.
Yeah.
We live on expectations of what these analysts say, and that's the way we trade our stocks. But do you really look at year over year and how's that stock performing compared to what it did last year? And how's that company really performing? And I think we sometimes look at the wrong things when we start looking at what the analysts really look at. But it is how the system works. And you're right. That's they've done a little better from an analyst expectation than what was expected.
Oh, yeah. The mantra when I worked at a publicly traded company was always do what you say you're going to do. And that's the standard you get held to. And by and large, they've been doing that so far, even if it is on a lower plane than expected. Speaking of earnings season, I know we've got a pile of them coming out. Got a couple of high points for us?
Well, let's just look. I'm looking at some different industries, right? So let's look at the electric car manufacturing industry for a minute, Dave, because we had 2 companies actually report within that industry. NIO, the China-based electric car company, now they had a wider than expected loss, but said that they expect their deliveries to nearly double this current quarter from what it was a year ago. Yeah, so they, the Wall Street's liking that. So they're actually up 10% this morning before the market gets going. The other company that we have that reported some earnings is going to be Rivan. They're I think they're the truck manufacturer, if I'm not mistaken, but put together the electric vehicle, and they had a smaller loss than was expected. They've kept intact their production schedule, so that's good. Now they are still facing supply chain issues, just like a lot of companies are, but they're up 14% this morning.
Wow.
Yeah.
There is some tech that's actually doing well.
They are. Now I will say they got beat up yesterday at the close. They were down almost 12% yesterday. So net, they're about even.
Go ahead, take the candy bar away after you get us excited, right?
Exactly. So, hey, so we had some other household names. Tapestry reported. That's the holding company for Coach and Kate Spade brands. They beat on the top and bottom lines for this last quarter, but they did come out and cut their full year forecast. Again, kind of a theme we've been seeing, right? The strong dollar is hurting them. And then China's COVID-19 restrictions are hurting them as well. They're trading down about 0.7% this morning. The company WeWork, they're the office sharing company. So you can get you a little cubicle where you can come into work. They had a wider than expected quarterly loss. They're also planning to exit about 40 underperforming locations this next month. They were trading down about 1.7%, but they've actually, I guess people like some of the things they're doing, and they're actually bouncing up about 6% this morning.
Lord.
That's a pretty cheap stock. You can go get it for $2.50. So.
And if you work with WeWork, you may very well not be able to work with WeWork if you aren't paying enough for your rent, right?
Exactly.
One or two more.
All right. So let's look at Bumble, the dating site. They've been kind of bumbling around here, it looks like. They actually did better from an earnings standpoint. They're expected just to break even, and they actually made 14 cents a share. But they came out and gave a weak earnings or a weak revenue forecast for the current quarter. Their renewing subscriptions are down, and so they're blaming it on discretionary spending because of inflation. That look, we can't afford a date. I guess we can't afford to find a date on Bumble because it costs too much, I guess. And so it's bumbling around today, down about 5%.
Oh, geez. Reset the table here for yesterday. It was a bloodbath yesterday, everything being relative. This morning, all of a sudden at 8:30, that U-turn I mentioned, my delayed quotes just updated. How big up are we at the moment?
It's not as big as a few minutes ago. It's basically about 2.4%. We're up. That's $794 on the Dow. The S&P 500 is up 3.2%. That's $120, folks. That's a big jump. The NASDAQ 100 up 4.2% right now. It's $451. And the Russell 2000 up 3.3% or $58. So a nice little jump across the board. Hey, I did want to mention this one. I know we didn't get a chance to talk about it, but let's talk about Bitcoin here real quick. It's at 5.8% right now from just this morning, right? It was down significantly, but I did want to mention this. So if you had bought Bitcoin a year ago, you would have paid $65,000 for it. Right now it's $17,400. So, hey, I hope you didn't do that.
I think we call that taking a bath.
Definitely a bath. On the other side of the coin, we got silver up 1.4% this morning, gold up 1.1%. And crude oil down significantly from yesterday, up though from its close about 0.75% to $86.50 a barrel right now.
Cool. Overseas markets, Asian Rim markets responded to ours yesterday, and they were all down. European markets are responding to ours today, and they're all up, and they're having party time halfway through their day. We got a big do tomorrow. If you've got something to do today, like, maybe sit around the house watching the storm go by, go through your shoe boxes and go through your files and box up some important papers, because we want to get rid of them tomorrow, right?
That's right. We got shred day, folks, tomorrow from 10 to 2. Come by behind our office, come in through Franklin Street. We'll have the shredder truck there, hot dogs, soft drinks, and then we'll have the Envy donut truck there. Come on by, shred your stuff, get a snack, and have the rest of a great day. Tomorrow is Veterans Day. Dave, I won't be with you in the morning. I will be preparing for tomorrow's event. So,
well, I guess I'll just have to muddle through and then see you at 10. Fair enough?
That's right. It's fair enough, buddy. See you then.
Be well, my friend. Thank you. It's 105.7 Light FM and Statler Financial Services. Phillip Statler.
Hey, folks, again, I want to thank you for joining us today. Remember, tomorrow, Friday, November 11th is Shred Day. Come by, get your stuff shredded, have a hot dog, have some donuts. Looking forward to seeing you guys then. Until Monday, have a great one. Bye now.